Hello, everyone, and welcome back to another episode. I'm your host and millennial investor, and today what we are going to be going over is what should the yield of your dividend portfolio be. Right now, if you look at my portfolio, if we go ahead and share my pie and we get it pulled up, let's go ahead and open it up in a different tab and look at the yield that I currently have. Okay, so here's my portfolio pulled up right here. If you guys go down in the description, you can see the referral link to get signed up with them on finance and also see my portfolio down below. But currently my dividend yield sits at around 3.3%, 3.287 to be exact. So that is a pretty steady dividend yield for my investing timeline. And my timeline is going to look somewhere around 15 to 20 years or so out. So a lot of my portfolio is designed around that number. A lot of my investments focus around the growth opportunities that I have. But one thing that's really interesting is that this is a good overall just dividend portfolio for really anybody out there. If you're wanting to retire next year or if you're wanting to retire 20 years from now, this is not a bad portfolio to own because of all the safe and steady growers out there. But thank you guys so much for tuning into the channel. So what we're going to be going over is the yield of a portfolio. We'll be looking at investing timelines of 5 years or less, investing timelines of 10 to 15 years, and then 15 to a 25-year timeline, and then last but not least, a 25-year plus timeline. I somewhere sit, like I said, around this 15, 20-ish year timeline, so kind of the in-between of these two, and that's why a lot of the stocks I recommend I already own in the portfolio. But it's going to be a fun one, guys. I'd like to thank Kyle Kennedy for recommending this. He says, here's an idea for you as a dividend investor. What do you think would be a good portfolio dividend yield? I'm about 2.89%, and I think I'm a little bit low. What do you recommend to be at for a total portfolio yield? Might make a good video. Thank you very much for recommending this video, Kyle, and we'll go ahead and address this in this video, and we'll also be looking at other things as well. So one of the things I wanted to look at, I wanted to show you guys an example, a real-world example, going back 20 years, starting with $1 million, withdrawing $50,000 a year, and how this will affect your investments and why portfolio yield is so important. Then we'll also be looking at a compound interest calculator, a theoretical withdrawal rate starting from $1 million, and how this could affect your investments. But it's going to be a fun episode, guys. Like I said, if you're not familiar with me, if you're new to the channel and you want to support my channel and you want to subscribe, I'd invite you to do so. You can watch me update these charts every single month involving my annual dividend income, YouTube income, monthly dividend income, and portfolio value. But thank you guys so much. And if you want to get signed up with this brokerage that I'm using, I have 56 people now signed up with M1 Finance, and this link is down in the description. So if you want to get signed up, you can sign up and deposit $100 to the platform and get $10 just for signing up. We'll each get $10. You'll help support my channel, and you can also get started on your investing journey. And that link is down in the description, as well as the 26 companies that I own that are all listed right here. So this portfolio has had a steady growth from $1,500 back in April when I started, and we've steadily climbed up from $2,000 to $3,000 to $4,000 to $5,000, $6,000, $7,000, and now we're on the brink of breaking $8,000. And actually, the other day, what was it, November 16th, we actually touched above 8 for the first time ever. And mostly that is because of two things: the earned dividends that just steadily goes up every single week, every single month, nonstop in the green, and then the market gain. We've had some pretty good market gains since we started at the very bottom of the stock market crash. But my portfolio is a steady all-weather portfolio, being able to handle pretty much all market environments. And the reason why I think that is so great is that as a dividend investor, you have steady, predictable income no matter what happens. You see that this number never has a downturn. It's up, 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 up every single month. Now we go back to this email here, in this little line, all information are estimates / guidelines. Market varies your investing results. So one thing that's really important here, when we look at this yield, this is constantly changing. Because if the market goes down 10%, this yield will be a different number. If the market goes up 10%, this yield will be a different number. So this is not a set in stone number that you have to follow. This is just to give you an idea and some basic guidelines around investing. And before we jump into the investing timelines, these 4 bullet points are something that I wrote down that I think pretty much all dividend investors should follow, regardless of when you're wanting to retire, regardless of how much dividend income you're wanting to attain. I think that this is pretty standard for all dividend investors. All portfolios should be diversified between 10 to 40 stocks and or ETFs. Usually what I recommend for dividend investors, just some basic ETFs that you should all look into. Some example ones is VOO. That's just the basic S&P 500. If you're wanting to go international, you could go VXUS. That's international stocks. Some other ETFs that you might look at that are a bit more managed that focus on dividend growth and dividend yield. For example, SCHD, as well as some others. But regardless of what strategy you're wanting to look into, I think you should be diversified no matter what your dividend yield is. Don't put all your money into 1, 2, 3, 4 different stocks. Be diversified between a minimum of 10, in my opinion. Now, next should be quality should always almost be chosen over quantity. It's better to have 10 solid, incredible dividend stocks rather than to have 100 just okay companies. It's best to choose your greatest performers, get that diversified between 10, 20, 30 different stocks, and then just pick your best winners and watch them grow over time. Don't be over diversified, but don't be under diversified either. Third is no frequent dividend slashers or cutters. If you're looking into stocks that have steady dividend payments and then cut them for whatever reason, don't look into companies that have a history of raising and cutting their dividends. One example of this is like NRZ, for example. NRZ is a company that constantly raises, lowers its dividend. That's not something that you should really be focusing on for your future. It's a little bit of a risk, a little bit of a gamble, but typically not something that you should be focusing on for the long term. Share price and valuation are also factors. Now, I know usually as dividend investors, we like to focus on yield, we like to focus on dividend and growth, but quite frankly, sometimes valuation has to matter. A lot of these tech stocks are getting to valuations that are at sky-high valuations. These dividend payers are not always what they crack up to be. So just remember, keep in mind valuation and share price. And in the long run, it does matter. It does matter. It's not always just about dividends. But a lot of these stocks are very high-growing stocks with growing dividends and growing share prices as well, with Johnson & Johnson being a great example of that. But let's go ahead and get into the first example. If your investing timeline is 5 years or less, if you're, for example, watching this video and you have a couple $100,000 invested and you're wanting to retire in, say, the next 5 years or less, your portfolio yield should be 4% plus. You should have a yield that is much higher than the one that I'm currently showing. So for example, one of the stocks that you would be cutting out of this portfolio that I have, here we'll look at my portfolio preview because this is the view that you guys see. You would be cutting out Visa. Don't focus on Visa. That is a high grower that is not good for someone that's wanting to retire today. Another one that you should cut out probably, maybe for example, Honeywell. Honeywell has a lot of opportunities in the industrial sector. They're growing quite nicely, but their dividend yield is under 2%. So for someone that's wanting to retire, that's another example of one that you might want to cut out of my portfolio. Now, dividend growth should be not very high demand. It should be at least 2%, so that way you can match inflation. But what you're really focusing on is this first line, the yield. You want a good dividend yield so you can fund your investing lifestyle. Now, these businesses should have established high-yield businesses with lifetime sustainability. These are companies that you could see still being around and still growing very gradually, very slowly, 10, 20, 30, 40, 50 years from now. So I'll give you some examples with all these strategies. I'll give you 3 ideal stocks that will go hand in hand with this portfolio strategy. So for example, Realty Income. Realty Income is a real estate investment trust that has a great dividend yield. Actually here, let's go to the preview view here. If we go to Realty Income, it currently has a dividend yield of 4.6%, so well over that 4% yield, but it is a safe, steady grower that is great for a retiree, and it probably grows that dividend at about roughly 3-4% every year, keeping up with inflation and a great dividend yield for someone that's wanting to retire. Southern Company is another great example. Southern Company is utility stock, a very safe, stable stock. People are always going to need their electricity. Homes are always going to need to power their homes and light up their homes. And basically, this company can grow its dividend about 2, 3, 4% every year, about the same thing as that of Realty Income. And then last but not least, the last example that I gave was WP Carey, which is also, by the way, one of my favorite stocks in my portfolio right now. This stock yields about 6%. So if you're a dividend investor and you're wanting to retire now or very soon, this is a great example of a stock that you should be focusing on because you can get a 6% yield and it still grows that dividend roughly, I would say, about 3% every year as of right now. And this is a great opportunity for someone that is wanting to retire now or very soon. Now, if we go to a 10 to 15 year timeline, now this is somewhere where around I sit, usually the 10 to 15 year to the 15 to 25 year. I usually sit kind of in between these two. So this is usually where I like to sit around, but usually the yield of this portfolio should be around 3.25 to 3.75. This is somewhere around what my portfolio usually sits at. Right now, it's a little bit low, the dividend yield, but that's because all these stocks have had huge share price appreciation over the last couple months. And usually it would be a little bit higher, at least about 3.5, 3.6%. But this portfolio should have roughly a dividend yield of about that range. Now, the dividend growth should be growing at least 5%. I think that this portfolio should be growing steady. I think that my portfolio, if I were to guess, I think that my portfolio, if I were just to throw out a guess based off of these charts and based off of the companies that I know I have in here, if I were to say an average year, I would say my stocks will probably grow dividends 7-8%, probably somewhere in that range. Some of them will grow a little bit slower. For example, like say a Coca-Cola is only going to grow about 3 or 4% a year, while other stocks, for example, like say Visa is probably going to be growing 10, 12, 15% a year. So it kind of averages out. I think probably about a 7-8% growth rate. I mean, for example, my number one holding last year, Broadcom raised its dividend 20, I think it was 22% last year. So incredible growth there by Broadcom. But I think that's pretty standard, about a 3.25 to 3.75% yield with a dividend growth of 5+%. These are established businesses with slow and steady growth. Something that you should be looking for here, I'll give you some examples. These three stocks that I gave you for examples for are 3M, Coca-Cola, and JP Morgan Chase. 3M is an industrial company that has raised its dividend for over 50 years. They are a dividend king, a very exclusive group in the stock market. And while it has slowed its dividend growth a little bit, it typically grows once again right around that number, around 7-8% over the long term, and currently has a dividend yield of about 3.4%. And then next up we have Coca-Cola. Coca-Cola currently has a little bit higher dividend yield, and like I said, it is growing a little bit slower. They have had some troubles, and they do have a 3.1% dividend yield, mostly because they just skyrocketed up quite a bit. They were a little bit higher, but this company raises dividend every single year for 50 years plus, and this company is solid for a long-term investor. JP Morgan Chase, just one of the big banks out there, a great financials company. And JP Morgan Chase currently, as of today, has a dividend yield of about 3.1% as well. And they once again grow that dividend, typically when they're not in a recession, 6, 7, 8%, just like that of 3M. But these companies are all great for this ideal portfolio. Next up, we have the 15 to 25-year timeline. This is once again, like I said, kind of where I lean, kind of in between these two. This has a yield of 2.25 to 3.25%, with dividend growth of 7 to 10%, if not more. Business with average yields with long-term growth opportunities. So you want companies that are steadily growing their dividends. They're not at the end of their cycles. Like, for example, Coca-Cola is not one that you would want in this portfolio. Coca-Cola is one that is not ideal for this portfolio as far as the dividend growth goes. They're usually going to grow their dividend 3, 4, 5% every year, and the same thing goes for something like Procter & Gamble. This is a company that will usually raise its dividend about, I'd say, roughly 5% a year. This is not a company that's going to be raising it 7, 10, 12% every single year. Now, I'll give you some examples of some companies that have long-term opportunities for long-term growth opportunities, but are still able to grow that dividend at least 7% and usually well past that every year. Broadcom, my number one investment, like I said, I believe it was 22% they raised their dividend last year. But I'm expecting a very high single digit to not low double digit growth of this company for its dividend raise that I should be expecting in a couple weeks from now. Another example of this is one of my favorite companies in this portfolio. Johnson & Johnson has a steady yield of about 3%, and it is growing that dividend about every single year, about 7, 8, 9%. Johnson & Johnson is the best healthcare company out there, in my opinion, and they already raised it about 7% this year. And then if we look at the last company, Starbucks, this is a company that has been raising its dividend 10% plus every year, including here in 2020. They just raised their dividend from 41 cents up to 45 cents, and they have a starting yield of about 1.7%, and they have had some great share price growth as well as some incredible dividend growth, over doubling in just the last 5 years. So these are three examples of some companies that go great with this portfolio. And then last but not least, we have the last timeline. If you have an investing timeline for taking money out of your portfolio 25 years or more. Now, a great example of this is, say, if you're watching this video right now, if you're 20, if you're 25, if you're 30, and you're wanting to invest a small amount of money, okay? So let's say, for example, actually here, I'll go ahead and do an example here. Let's say you're wanting to invest, say, $200 a month, okay? Let's say you want to invest $200 a month, and let's say you're 30 years old, and you want to retire, say, 35 years out. When you're 65 at retirement age, you're just saving this for the day that you retire. Let's go ahead and say $250 a month. Your investing timeline is 35 years, and let's just say an estimated interest rate of 10%, because you're looking for companies that are growing quite substantially. You don't want companies that are at the end of their growth phase, like a WP Carey or Realty Income. You want stocks that are raising their dividend 10, 12, 14, 15% every single year. And let's just put a 0% range, compounded annually or compounded monthly, because you're contributing monthly. And then at the end of that 35 years, you'd have right around $1 million. 950,000 would be your rough estimate. If you want to see what this looks like with about a 2% range, if you're growing at 8% or 12%, this is what it could look like at the end of that timeline. So this is an example for someone that is investing a small amount with a long-term growth horizon. You should have a yield of less than 2%. Once again, like I said, skewing more towards growth than yield, and a dividend growth of at least 10%. preferably well over 10%, and developing businesses with high growth opportunities. This is not like the last one where I said average yields with long-term opportunities. These are companies that are a bit more established out there. We want companies that have hyper growth opportunities. In 3 stocks, for example, of this, one of these I own, 2 of these I do not. I did own Microsoft before, but I did sell out of it. I am an owner, I am a shareholder of Visa, and it is one of my largest investments. And they're usually, during a typical environment, growing that dividend at 13, 14, 15% every year with incredible share price growth as well. You can see over the last 5 years, $80 a share, now they're 203. The other ones that I gave an example of was, for example, Microsoft. Microsoft is a company that is a tech giant that is growing its dividend, usually 10% plus every year. And I believe they already raised that. Yeah, they already raised that about another 10% here in 2020. And another example is Nike. I know Nike just raised their dividend at about 12% or so just this year. And I think Nike is another long-term grower out there that is perfect for a long-term investing timeline. But that overall, guys, is what you should be looking for. Like I said, these are just basic estimates and basic guidelines. This can vary off of a lot of different factors. Basically, what the market is doing, what these different companies are being valued at during specific times. But this is just to give you an idea of what to look for if you're new to dividend investing and if you want to focus on the long term. This is really exciting if you haven't started before. And if you want to watch my investing timeline, if you want to see some proof in the pudding, if you want to see me put my money where my mouth is and invest in these companies that I'm recommending, you can see it right here. These are the 26 companies that I currently own. And like I said, we're seeing steady growth with $80 in dividends and well over $1,000 in market gains. And we have another $12 to invest, as well as another $100 deposit that I'm about to do right after I shut off this camera. So I'd invite you to subscribe if you want to follow along with me and watch these charts grow every single month. And if you want to get signed up with M1 Finance, this link is down in the description, as well as my portfolio and a lot of other things down in the description. So go check that out and get this number up to 57 referrals. But thank you guys so much for watching all the way to the end. I appreciate the recommendation for this video. Go ahead and leave a comment down below so you can refer another video idea towards me. But thank you guys so much, and I'll speak to you guys next time.